call on stage now from Shriram Mutual Fund, rather Shriram Capital, Mrs. Subhashri Shriram. The name suggests that she might be from the promoter family.
Good morning. Just to set the record right, I'm not from the family. Started as an accounts person, accounts of assistant. That was my first job, and before you today. Also set one more record straight. Shriram Group does not have any family members. It is not a group which is run by any family. It's many in Chennai may have heard of it. It is one Mr. R. Tyagarajan, who is the founding member of the group. And today it is completely managed and run by professionals and owned and run by professionals. So proud, very happy to be before you here. What is Shriram should I talk about? The thing which occurred to me was a story which all of us in our childhood, Ama Moyal Kada. And in the Kalata Ama Moyal, just want to clarify it. We are not the old hare and the tortoise story. It is today's generation of hare and the tortoise. And I want to clarify, we were the hare. We started very early. 1994, Shriram Mutual Fund came into being. In fact, so ambitious that we even listed the company. But அந்த காலத்து ஹேர் தோத்து போயிடுத்து தூங்கிடுத்து இந்த கார் ஹேர் தூக்கத்துலேருந்து எழுந்து ஓட ஆரம்பிச்சிடுது. So we are here to run now. We are back here. The other thing which is a very long break. நடுவில் சில பக்கங்கள் காணும் எங்களுக்கு. அந்த பக்கத்தெல்லாம் தேடி கண்டுபிடிச்சி we'll come back. Don't worry. We are here. So it's been a clear near 30 years. But a lot of things, I think, again, like Rajinikanth, later vandalo latest vandirukom. Right time, market is picking up, India is shining. We have crossed many challenges. The India is now, what we see post-COVID is an India which is very, I could hear what I heard from HDFC, and I'm going to hear it in the rest of the day, is a very prosperous, very forward-looking India. And what better time to enter the mutual fund? We are the right time. The group is extremely excited. நீங்கள் நிறைய பார்த்துருப்பீங்க எங்களோட ரீஸ்ட்ரக்சரிங் அந்த சேஞ்ச் இந்த சேஞ்ச். ஸோ பீப்புள் மஸ்ட் பி ஒண்டரிங் என்ன நடக்குது ஸ்ரீராமில். தரம் ஏதோ ஒன்று மாக்குறாங்க, சேஞ்ச் பண்ணுறாங்க, இந்த கம்பெனி அந்த கம்பெனியோட மர்ஜ் எடுத்து இந்த கம்பெனியை விற்றுட்டாங்க. ஸோ ஆல் தட் இஸ் ஆல் த ரைட் டைரக்ஷன். திஸ் இஸ் ஜஸ்ட் we are doing our few years, a little bit of consolidation. So many of our group companies, just to take it 2 more minutes, Shriram, chits therinjadavanga yara irukangala inga? Aarume illa. I'm very happy. And chitla paisa podadavanga irundinga ipo poduga. Chit inna nalla irukku. I'm not saying it's a competition to mutual fund. It is a similar product, a saving product, a borrowing product, but chit is a very native tool of the Indian market. So Shriram adala aarbidichi இன்னைக்கு லேட்டஸ்ட்டாக வந்து மியூச்சுவல் ஃபண்ட் ப்ராடக்ட்லேயும் இருக்கும். ஸோ ஓல்டஸ்ட் சிட் ஒரு சேவிங் ப்ராடக்ட்டும் இன்றைக்கி இருக்கிற லேட்டஸ்ட் மியூச்சுவல் ஃபண்ட்லேயும் கோயிங் ஃபார்வர்ட் இன் PMS, AIF, every investment product, Shriram will be there. So we bridge two extremes, the oldest and the latest, Shriram will be there. In this 3-5 decades we have just completed. In the last 2 decades, we have consolidated ourselves to be the largest NBFC. Some of you may not be aware, and I want to take this opportunity, that we have a very successful insurance company, life insurance company. Not of scale of the larger names, but very profitable. Very efficient, very efficient life insurance company. We also have a very an institution of creating records of sort in claim management, in efficiency and profitability is our general insurance company. And latest, Shriram AMC and Shriram Mutual Fund is going to follow the trend of the Shriram Group. We will definitely assure all our stakeholders here before us that we will be true to our name, Shriram name, this new venture of us, being the most efficient, trusted name. And we, as you would have seen in Shriram, we will very happy to take partners. Because as I said at the beginning, we are a homegrown company, no family institution to back us. It's a bunch of professionals. So we bring in partners very happily. We welcome partners with open hands. And these partners are going to help us. And you can see more activity in this with more partnerships, more engagements with specialists. And we'll hope to deliver a lot more. And you're going to hear my colleague Deepak talk to you in a while. Thank you so much for giving us opportunity.
Thank you, ma'am. Let me welcome on stage Mr. Deepak Ramaraju, Senior Fund Manager from Shriram.
Mr. Deepak Ramaraju is the head of equities at Shriram's AMC Limited and has earned over 17 years of experience in the equity markets and is a chemical engineer by academic background. He has begun his investment career with investment management South Africa's top 3 asset managers, where he ran their 20 members offshore equity team and advised their Indian Opportunities Fund. The fund successfully delivered over 3x returns and consistent alpha in a span of 4 years. As a part of partnership between people of groups, Deepak moved into Shriram Life Insurance as their interim CIO, where he rebuilt the fund performance. Prior to joining the investment world, Deepak was a researcher and co-investor at GC India Technology Center in Bangalore. His innovative approach is reflected in 10 patent to his credit as a co-investor at GE. His Six Sigma Green Belt has helped him bring a robust statistical lead approach to developing and quantum strategies at Shriram AMC. We welcome you, sir.
Good morning. Vanakkam, Chennai. Yeah. So, I'll be just talking about Quantamental. This is an investment philosophy that we have in Shriram Group in the AMC business. Now, what is Quantamental? It's going to be the future of investing, a new approach where the investment will be taken up in a different way. So, more importantly, from an investment manager perspective, how do we generate alpha? Many of you know what is alpha. It's nothing but your fund return minus a benchmark return. How much excess return we are making over the benchmark. But to generate this alpha, there's a lot of subjectivity. Now, what is the subjectivity all about? Company A when the 14% grow, the company B when the 12% grow. So how do you pick between company A and company B? There's a subjectivity involved in that. And the growth rate, that's the subjectivity that we are bringing onto the table. So how do we minimize the subjectivity? How do we bring in more data into this? If you have more data, your judgment will be more, you'll have more clarity on the judgment basically. Then you can pick the right winners. So the main aim of this entire approach is to how do we minimize the subjectivity and how do we do this? And can we generate alpha sustainably on an ongoing basis? That's what this presentation is all about, and I'll show you how we have done that. So what is investment? Investment is nothing but art and science. It's a combination of both your art. And what is art? Let's start off with what is the art. We all know Mr. Warren Buffett. He's the master who has mastered the way of art of investing is all about. So what is the art here is understanding the long-term investment focus of the company, basically. How do you identify the investment opportunities and have a view in the longer-term perspective? You need to identify consistent compounders here. When I tell about consistent compounder, it's nothing but the fundamentals has to be really good. The management who's driving the company has to be really good. They have to be focused. They have to keep doing things in a disciplined approach. They have to be delivering performance on a quarter-on-quarter basis, and they consistently keep growing. The focused nature is what is very critical. That's identifying this. And you try to visualize what's going to happen in the next 5 years or 10 years for the company. That's the art here. Because everybody cannot visualize completely what's going to happen in the future. So that's the art. Basically, understanding a deep fundamental understanding of the company is very critical here. Excuse me. It's not working. Yeah. So there's a pros and cons with the art. Now, what are the pros? You get a long-term understanding of the business. You get a long-term view of you'll create a long-term investment focus. It's not short-term trading. You try to build an investment book which is meant for long-term. And there's a lot of subjectivity involved here. There's a value investment approach. Basically, you're trying to pick companies with cheaper valuation and try to buy and hold for the longer term. And more importantly, you'll be making decisions based on certain data points or certain kind of information that you get from the company or from the macroeconomic perspective. That is what you'll be using that to make the decisions here. You will be making an informed decision. But more importantly, what are the cons? It's time consuming because you need to spend a lot of time understanding the management, understanding their business, and you need a bigger team to do this kind of research. One. Second thing is there's a lot of subjectivity. As I said, you need to understand how the company grows, which company is better. If I have to look between company A, B, C, which is the better growing company? Now, how do I identify that? There's a lot of subjectivity. You put in some growth rate. So you assume certain growth rate. This company can do this much growth. So that subjectivity is what is going to be the negative aspect in this kind of investment decision. And most generally, fund managers can become biased. Like doctors who cannot love the patients, similarly fund managers cannot love the companies. But doctors and fund managers are similar in this aspect. You can't love your companies. Similarly, doctors cannot love the patients. You cannot be biased. No fund manager can tell, I like this company. The word like is very dangerous for a fund manager. You'll have to be very clear. Basically, you're in the business of making money. Make money, get out. And more important is lack of critical information. For you to make a decision on the future, you need the right kind of information. The lack of information is what is going to be detrimental for this process. Now, let's look at the science part of it. What is science? Mr. Jim Simons is a veteran in the quantitative investments. He's a mathematician who started his investing at the age of 60. He's a person who is known for delivering more than 60% kind of compounding return on sustainable basis. Now, what did he bring to the table? It's all about your data sciences. He built in a lot of mathematical models or quantitative models. You can analyze companies based on alternative data. It might be like, to just give an example, how the crude price will interact with your companies like all marketing companies. What is the correlation or covariance of that? What is the impact of the global supply demand? Build in a correlation or covariance of the data here. So you map different perspective of data. Look at from a global perspective. Look at from a domestic perspective. You look at multiple data points before you arrive at a decision. You bring in the relative matrix between two data points. Understand which data is going to get impacted by the other data. Now that is very critical. That's what quantitative investment is all about. You can look at multiple factors. There's a factor-based approaches. You look at company fundamentals. You can put the company fundamentals as a data, the historical fundamental that determines how the management has worked in the past. Now, how do you forecast that? How does that get impacted with different data points on the globally? So those are the things. So here the science of investing is nothing but getting the right kind of data, and data will be the key thing. Now, what are the pros and cons here? It's a data-driven approach completely. You're dependent on data. And more importantly, you can build in speed and efficiency. And typically the quantitative approach is rule-based approach. You bring in certain rules. If my ROE is not growing at more than 15%, I'm not going to invest in companies. So you can build in your rules. You can build in your kind of risk limits here. And more importantly, the quant investments are very adaptable to market changes. When I talk about market changes, for example, last year, like 2022, 23, post-COVID, we had shorter market cycles. You had 1 month where auto stocks starts rallying, 1 month defense stocks rallying, 1 month railway stocks rallying. These are some of the examples. Like market cycles are shorter. And how do you build a conviction? How can quant adapt to these changes? So that's where the mathematical models help in doing that. What are the negative aspects of this way of investing? It's lack of critical data. If you don't have the right kind of data, you might not be able to get the right kind of information, or your mathematical models may not be accurate. Garbage in, garbage out. If you put a wrong data, you'll get a wrong information and your decision will be wrong. And more importantly, the models can become very complex. As we get more and more data and try to fit in more and more information, the models become very complex. That will also need a lot of computing power. So you need huge amount of servers and kind of spaces and the efficiency of the systems to deliver kind of compute data. So data and computing is a key thing here, basically. Now, what if we marry both? So if you marry both, that's the science and art. That's what we call as quantamental. Quantitative plus fundamental. Both put together is nothing but the quantamental. If you take the best of both the worlds, you take the best of science, the mathematical models, and your long-term vision on the companies, or ability to understand the company, the fundamental aspect. Both if you bring together, that's what we call it a quantamental. Now, it's about man and machine working together, delivering an alpha. It's nothing but AI, alpha intelligence. Now, why do we need a kind of why do we need quantamental? What are the key asks here? More importantly, you need a simplified process with a simplified research approach. You need a process-driven approach. You need to be having disciplined approach. That's the bottom line there. And more importantly, you need to have very limited subjectivity. You don't want the fund managers or the analysts to keep thinking what's going to happen in the future, what can be the growth rate, what can be the kind of predictability of the companies. You want to have limited subjectivity here. And the decision-making process has to be very simple and it has to be data-driven. And you need to be efficient, nimble, and very process-oriented here. When I tell efficient and nimble, you need to be able to identify the kind of market dynamics. How do you change the market, how the market dynamics are changing, how the market cycles are changing? How do you adapt for that? How do you adapt with more and more people participating in the markets? Markets have become, the dynamics of the markets keep increasing. The dynamism, how do you adapt to the dynamism? That's the efficiency of the process that you need to bring in. And you need to be able to, with all these things, you should be also able to identify trends in the longer term. You need to be able to deliver alpha on a consistent basis. And you need to identify the trends. You need to identify winning stocks. And you need to take a comprehensive approach here. So what has been our approach? What is the kind of quantamental approach that we have brought in here? We have started off with the factor models. We take a two-step approach here. The first step here, we try to bring in the factor approach. Now, what are factors? Factors can be any kind of, how do you define a particular parameter on which you want to rank companies about. For example, I want to invest only in companies starting with letter A. That can be a factor. So I'll identify all the companies which are starting with letter A. That can be a simple factor as simple as it is. Now, what is its return in the past? If I invest in all the companies starting with letter A, what is the return that has generated compared to the broader markets? That's what we study. That's one of the factors, like just giving an example. Not necessarily we need to use those factors. You can identify net profits as a factor, net profits growth as a factor. You can use momentum as a factor, which many of you have been listening quite often. Now, what is momentum? It's nothing but the rate at which the stock price is changing or increasing or growing. It can be volatility as a factor, low volatility. So you have multiple factors. I'll be talking about the factors that we study basically. So we take a multi-factor approach. We rank all the companies based on these three or four factors. When once each company is given a factor score, you take a comprehensive view and then a cumulative score of all the companies. You rank them in a descending order. Normally, the old school of thought was we used to screen the companies, we used to filter the companies. I used to filter out companies greater or lesser than ROE. I don't want it to be the portfolio. I want only companies with greater than 15% ROE. I want companies which are growing more than 20% year on year. We used to screen the companies. Now we are taking a ranking approach in factor investing. Why do we do that? Why do we do a ranking approach? A company which was growing at 15% might drop down, but it can always come back. You should be able to identify those winning companies which are reinventing themselves. So that's why we take a screening approach. By doing a ranking approach, you will be able to identify those opportunities as well. And you can also identify short-term trends by ranking the companies. Because in the short-term trends, the ranking also can change. When I tell it's short-term, it can be even 1 to 2 years. You identify the companies based on the ranking part of it. We rank all the companies based on certain factors. Now, if you look at the top 30 or 40 stocks, for example, I'll just take momentum, low volatility, valuation, and quality. If I take 4 factors, that means to say the companies which are ranking on the top are consistently in momentum, they have least volatility, they continue to be cheaper relative to the broader markets, they'll also be good in quality. So if I rank all these 4 factors on the top, and I pick the companies, I don't have to spend, my analyst should not have to spend time looking at all the 500 companies and analyzing all those things. They can just focus on those 60 or top 100 companies, just focus on that. Go behind those companies, understand what's happening there, why these companies are getting ranked there on the top first. Getting that understanding is very critical, why the company is coming in momentum. When once you have a clarity on why the company is coming in momentum or why they're ranking on the top on the quality, you get to know what's happening behind that. Then you can talk to the management and get clear-cut understanding. Then you can actually put your fundamental cap and look at what's going to be this. Is it sustainable or not? Is this trend sustainable? Are they able to kind of maintain that kind of inertia in there? That is very critical here. When once we do that, the output of the ranking is taken as an input for your fundamental analysis. That's why we do a deep dive analysis into fundamental analysis. We will be focused on those top 100 companies or 80 companies, get a clear-cut understanding. Now, these 80 companies can keep changing with changing market cycles. The companies which are there on the top might come down. So, we'll be able to identify the winning stocks here, build a portfolio of 30 to 60 stocks. The main objective is to deliver alpha on a sustainable basis. Every market will have a cycle. So, as mean reversion happens, even the models will also have a mean reversion. The model will try to learn from itself. So what is the edge that you can get? You'll be having a simplified process with limited subjectivity. You don't have to spend too much time and analyzing all the companies in your universe. You can just create a focus list of companies and go behind them more aggressively. You'll have a limited subjectivity because, for example, if I'm testing my blood test, doing a blood test on a regular basis or checking my BP and sugar, that means I'm checking my health condition. Similarly, a stock price reflects the health of the company. If something positive is happening in the company, that means the stock price is going up. That's a simple indicator. Now, on what pace it is growing or how the way it is growing, that's a critical aspect. If the volatility is increasing, that means to say the certainty or the positivity in the company is not good. If it's less volatile and consistently going up, that means to say there's something sustainable happening in the company. The management is doing the right kind of thing. It's an indicator. It indicates what's positivity happening in the companies. So you can just analyze these things. So your momentum or low volatility factors or the quality aspects, that will give an indication what's happening in the company. You can identify the winning stocks. You can also time the entry and exit more precisely. If the stock is coming in momentum, that means to say something positive is coming at that point of time. You can time it. And the moment the valuation is increasing or the moment your volatility is increasing or for the moment the momentum score is reducing, you can exit the stock. That's an indication when you want to enter or exit the stock more precisely. You can time the entry and exit. That's a very good advantage of these quant models. And more importantly, you can the models will learn itself based on the changing market dynamics. If suddenly the market changes, it's become too expensive. So automatically the valuation will automatically, you're picking up the stocks which are still relatively cheaper. It automatically learns. The valuation of the stocks, underlying stocks are becoming expensive. So it ranks. You're ranking the stock which are relatively cheaper. You're identifying the next stock that has to go into the portfolio. It learns from the market dynamics basically. And your fundamental approach can still augment the quantitative models also. Sometimes the models might predict certain things. It's a rule-based approach. So you want to break the rule. Suddenly some bad news happens in a company. You don't have to wait for the end of the month for rebalancing or the rebalancing. The rule can be broken even by the fundamental analysis. You can understand what's happening in the company. When once you know certain bad thing is happening in the company, you can just take a call and exit the stock. That's the advantage. Your fundamental can augment the entire process. And from a performance point of view, it helps you to deliver sustainable alpha in the medium term to long term. Certain factors helps you to minimize the drawdown. You can minimize the drawdown in the medium term and long term. And it sustains capital growth. It helps you to grow the capital, basically. Now, some of the factors, how they work in different market cycles, whether it's in a growing market, it can be your bull market or a bear market. It can be even your recovery period in the market dynamics. The business cycle, it can be your expansion or kind of contraction. This is the data I've taken from S&P Dow Jones. So different factors have different performance. So we understand now which factor we need to take in different market cycles. So those factors help us to navigate the market volatility at different points of time. So identifying, right now we might be using 3 factors. Tomorrow the factors will change. The factors can adapt based on the market dynamics also. We can change the factors. Now, current factors that we are currently using, momentum, volatility and value, and we are also using quality. So momentum is nothing but your returns, 12 months and 6 months returns, the standard definitions, risk-adjusted returns. Your volatility is inverse of your standard deviations of daily returns, and value is your price to earning and price to book of the stocks. Now you rank all the stocks. Quality point of view, you will evaluate everything, right? The growth rates, the financials of the company, the management quality. You look at the ratios, the leverage of the balance sheet, you evaluate that. And once you're convinced the stock is good, then you can add it to the portfolio. What has been the impact for us? I started implementing this Quantamental model from 1st of September 2023. I joined in 2022 of August for the EMC. It took me 8 to 9 months developing this quant models. After that, my board did not allow me to implement that immediately. So we took a baby steps. We monitored that parallelly, how the models really work. Then when once 1st of September, we started implementing. If you look at from 31st August, the performance, we were in the bottom of the performance. That's also because the previous we had many changes in the fund managers, the investment philosophy was not intact. It took us some time to build the entire process, revamp the entire portfolio. We had to change the portfolio completely. When once we did that, we saw the performance coming in. From Q4, we moved to Q1. So the alpha, for example, if you look at the alpha delivered, we were underperforming by minus 2.54. We are almost there at almost in a 1 year performance, we are almost delivering 9% alpha. Our ranking from the bottom of the pyramid, we moved up to the top. It's not about performance happening, but the only point here is the process can help us to deliver sustainable alpha here. And we have implemented the strategy across all the funds, not just one of the schemes. We don't have only one quant fund in our system. We have the Quantamental approach across all the schemes. All the schemes run on the similar approach. Similarly for the FlexiCap and ELSS. We also, when we launched the multi-asset allocation, we backtested this completely. All the schemes have been backtested, by the way. So just taken an example here on the backtested results. So when we backtested this strategy, if you look at the alpha that we delivered on a 1 year period, that's almost in line with the alpha that we're delivering on the live portfolio also. It's not that our backtested results are different and the live portfolio is different. We're able to demonstrate that both. And more importantly, the drawdown analysis. So during the COVID period or during the global financial crisis, the model was able to reduce the drawdown and recover much faster compared to the broader markets. That's the advantage of this process. So would be happy to answer any questions or thank you very much.
Thank you, Mr. Deepak. Please stay on the stage. So yeah, you can have a lot of questions, but there are no answers. We don't have time for question answers. They can take it offline. Invite on stage Nagarajan. All are running outside. What is there outside?